In this video, we are going to talk about the top 5 investing mistakes to avoid. So, before starting this video, please like this video and subscribe to our channel for future updates. If you're interested in investing, it's important to know that everyone makes mistakes, but you can learn from the mistakes of others to help avoid making them yourself. This can help you build confidence when it comes to investing, giving you positive momentum for reaching your long-term goals. Here's a list of the top 5 investing mistakes to avoid. Let's start. Number 5. Trying to time the market. Investing in individual stocks can be a tricky game. When you buy shares of a publicly traded company, you'll have an ownership stake in that organization. The idea is to sell shares for more than what you paid for them so you can turn a profit. One of the most common stock investing mistakes is trying to time the market so that you're buying and selling at the exact right moment. The stock market is constantly in flux, and a wide variety of factors can impact stock prices. Earnings reports, industry trends, scandals, economic conditions, and political developments can all push stock prices up and down. This helps dial down risk because, if one stock or sector underperforms, you have other holdings in your portfolio to help make up the difference. Number 4. Failing to diversify. Diversification is meant to spread out investment risk so that all your eggs aren't in one basket. For example, if the bulk of your investments are in individual stocks within the tech sector, what will you do if there's an industry-wide lull? Or if your top-performing shares unexpectedly drop in value? If you aren't diversified, it could lead to significant financial losses. Investing in exchange-traded funds, index funds and mutual funds is one way to diversify your portfolio. While stock investing, real estate and cryptocurrency are considered high-risk investments, you can balance your portfolio with low-risk assets like bonds, certificates of deposit, and money market accounts. Safer investments typically generate modest returns, but they can provide some much-needed stability. It's something to think about when choosing the right asset allocation. Diversifying can help mitigate risk and position your portfolio for long-term growth. Number 3. Paying high fees. One of the biggest investing mistakes is overlooking potential costs. Here are a few ways you could encounter fees as an investor. Trading commission. When investing in exchange-traded funds, some brokers may charge a fee of up to $25 per trade. Others may not charge a trading fee at all, so it pays to shop around. Operating expense ratio. Mutual funds and exchange-traded funds both charge a fee to cover administrative costs and portfolio management. This fee is charged as an annual rate and is calculated as a percentage of your investment. Mutual funds are actively managed, so their operating expense ratios tend to be higher than exchange-traded funds. Robo-advisor fees. A robo-advisor is an automated advisor that recommends and manages your investments based on your risk tolerance and financial goals. They're usually more cost-effective than working with a financial advisor or fund manager, but they aren't free. Some charge annual management or advisory fees that can range from 0.20% to 0.50% of your account balance. Financial advisor fees. You may prefer to have a financial advisor manage your investments on your behalf. Management fees here are generally around 1% to 2%, which can add up as your portfolio grows. Brokerage account fees. If you invest through a regular brokerage account, you may be charged account maintenance fees. There might also be fees for buying and selling investments. Number 2. Missing out on an employer match. Over 2/3 of private industry workers had access to employer-sponsored retirement benefits in 2021, according to the U.S. Bureau of Labor Statistics. If you invest in a 401(k) through work, your company may match some portion of your contributions. Many employers offer this perk to incentivize saving, and it's essentially free money. Let's say your annual salary is $100,000 and your employer will match 50% of your contributions up to 4% of your salary. If you kick in the full 4% per paycheck, it would automatically unlock another 2% from your employer. That's an extra $2,000 per year. Leaving this money on the table is a common investing mistake. Aim to contribute at least enough to snag an employer match. Number 1. Over or under investing. Before you begin funneling money into investments, you'll want to make sure you're standing on solid financial ground. If you're struggling to cover essential expenses, don't have an adequate emergency fund, or have excessive debt, investing might not make the most sense. While the stock market has produced an average annual return of 10% since the 1920s, average credit card annual percentage rates are over 20% at the time of this writing. Numbers like these suggest that paying down high-interest debt is more prudent than investing. That's it for today. We hope you found our video interesting. If you did, please give it a big thumbs up and share it with others. Also, if you haven't already, please consider subscribing to our channel. Don't forget to turn on the notification bell so you don't miss any of our new uploads. In the end, thanks for watching, and see you next time.